Good evening and a warm welcome to all the participants. There is an earnings presentation deck published on our website. Please refer to it as appropriate. As you get to it, in the meantime, let's cover a brief on the macroeconomic environment that operated during the quarter before we review the earnings. We continue to see healthy domestic activity, economic activity driven by robust government spending, primarily in capital expenditure, improvement in domestic manufacturing, and resilient services sector performance. As you know, the GST collections grew 13% year-on-year. Manufacturing and services PMI continue to remain in the expansionary zone. On the consumption side, improved consumer demand driven by festive spending resulted in robust growth across various sectors. RBI kept its rate unchanged at 6.5% and retained its stance unchanged at withdrawal of accommodation and modestly reduced its inflation forecast in the second half of the year. As we look ahead, the economic environment is poised for strong growth. India's year-on-year GDP growth for financial year 24 is estimated at about 7%, and for financial year 25, GDP growth rate is expected to be around 6.5%, continuing to be one of the fastest growing major economies in the world. Let's go through the key factors of the bank's growth journey. Advances can be referred to in page 7 and 8. Gross advances are at rupees 24.7 trillion as of end December, reflecting a sequential momentum of rupees 1.1 trillion or 4.9%. Retail advances grew 3.3% quarter-on-quarter, primarily driven by strong performance in the mortgage business. Retail mortgage disbursements of rupees 460 billion during the quarter grew 18% over prior year. In the CRB business, it continued its strong momentum, registering quarter-on-quarter growth of 6.7%. Wholesale segment, excluding non-individual loans of HDFC, grew 1.9% sequentially. Non-individual loans of HDFC aggregated to 0.99 trillion as compared to 1.03 trillion as of last quarter end. Focus on the granular deposit continues. Looking at pages 7 and 9, total deposits as of December end amounted to rupees 22.1 trillion, primarily comprising of retail deposits, which is at 84% of total deposits. Retail deposits, which are the bedrock of the franchise, grew by over rupees 530 billion or 2.9% during the quarter, while non-retail deposits reduced by rupees 118 billion quarter-on-quarter, resulting in total deposit growth of rupees 411 billion or 1.9% during the quarter. Current account deposits ended the quarter at rupees 2.6 trillion, registering a growth of rupees 80 billion or 3.2% sequentially, or rupees 280 billion, 12.3% over prior year. Savings deposits as of December end at rupees 5.8 trillion grew rupees 99 billion or 1.7% sequentially and over rupees 440 billion or 8.3% year-on-year. Overall, CASA deposits ended the quarter at rupees 8.4 trillion, resulting in a CASA ratio of 37.7%. Term deposits aggregated to rupees 13.8 trillion as of December end and grew by rupees 232 billion or 1.7% during the quarter. On the distribution footprint expansion, referring to page 10, it reflects our branch network, which stood at 8,091 outlets as of December end. Overall, there has been an increase of 908 branches over the last 12 months. During the quarter, we added 146 branches, which is at the rate of 1.6 branches per day. Payment acceptance points are at 4.8 million and year-on-year growth of 25% as adoption of Vyapar app builds momentum. In CRB, our rural business reach expanded to 210,000 villages, a growth of 60,000 villages over last year. In the customer franchise building, we added 2.2 million new customer liability relationships during the quarter and around 7.4 million relationships so far in the current fiscal year. Our customer base stands at 93 million customers. This provides an opportunity to further engage and deepen our relationships. In order to position us for greater engagement, we have added 41,000 employees over the last 12 months and 10,000 during the quarter. On cards, we issued 1.6 million new cards in the quarter. Total card base stands at 19.9 million. You'll see on page 11, balance sheet remains resilient. LCR for the quarter was 110%. Capital adequacy ratio was at 18.4%. Tier 1 ratio at 16.8%. Let's start with net revenues on pages 12 and 13. Net revenues for the quarter were at rupees 396 billion, grew by 25.8% over prior year. Net interest income for the quarter, which is 72% of net revenues and is at 285 billion, grew by 23.9% over prior year. The core net interest margin for the quarter was at 3.4%, and on an interest earning asset basis, net interest margin for the quarter was at 3.6%, both flat to prior quarter. Getting to the details of other income on page 15, total other income was at rupees 111 billion. Fees and commission income, which is almost close to two-thirds of the other income, was at rupees 69 billion and grew by 15% over prior year. Retail constitutes approximately 94% of fees and commission. FX and derivatives income at rupees 12 billion was higher by 12% compared to prior year of 11 billion. Net trading and mark-to-market income were at 15 billion for the quarter. Prior quarter was at about 10 billion. Other miscellaneous income of rupees 15 billion includes recoveries from written-off accounts and dividends from subsidiaries. Referring to page 16 on operating expenses for the quarter, which were at 160 billion, an increase of 28% over prior year. Cost to income ratio for the quarter was at 40.3. Cost to assets was at 1.9%. Coming to the asset quality on pages 17 to 19, the GNPA ratio was at 1.26% compared to 1.34% in prior quarter and 1.23% prior year. Out of the 1.26%, about 15 basis points are standard, thus the core GNPA ratio is at 1.11. However, these are included by us in NPA as one of the other facilities for the borrower is in NPA. Net NPA ratio for the quarter was 0.31%, prior quarter was at 0.35%. The slippage ratio for the current quarter is at about 70 billion or 26 basis points. Last quarter was at about 78 billion. During the quarter, recoveries and upgrades were rupees 45 billion. Write-offs in the quarter were at about 31 billion. No sale of NPA accounts during the quarter. On the provision side, total provisions reported were around rupees 42 billion, and excluding the contingent provision, it was rupees 30 billion as against rupees 29 billion during prior quarter and rupees 28 billion for the prior year. As I just mentioned, the total provisions in the current quarter included additional contingent provisions of approximately 12 billion, and it is pertaining to investments in AIF on a prudent basis. The fair value of these AIF is up by rupees 5 billion, but 100% provisions have been taken at book value. The core specific loan loss provision for the quarter was around 26 billion as against 25 billion in the prior quarter. The provision coverage ratio was at 75%. At the end of current quarter, contingent provisions and floating provisions were approximately 154 billion. General provisions were 105 billion. The total provisions comprising specific, floating, contingent and general were about 159% of gross non-performing loans. This is in addition to security held as collateral in several of the cases. In addition, the bank holds contingent provisions of rupees 12 billion on a prudent basis towards AIF, as I just mentioned. Floating contingent and general provisions, excluding that contingent provision on AIF, were about 105 basis points of gross advances as of December end. Coming to credit cost ratios, the total annualized credit cost ratio for the quarter, excluding the contingent provisions I just referred, was at 49 basis points. Prior quarter was also at 49 basis points. Recoveries which are recorded as miscellaneous income amount to 13 basis points of gross advances for the quarter as against 16 basis points for the prior quarter. The total credit cost ratio net of recoveries was at 35 basis points in the current quarter as compared to 34 basis points in the prior quarter. The profit before tax was at 194 billion, grew by 19.8% over prior year. After the rupees 15 billion of tax provisions no longer required, consequent to the favorable orders received, net profits after tax for the quarter was at 164 billion, grew by 33.5% over prior year. Summaries of subsidiaries can be seen on pages 21 to 26. On HDB, to cover on HDB, the quality of the book continues to see sustained improvement with a gross stage 3 at 2.25% as of December against 3.73% as of prior year. Provision coverage on stage 3 books stood at 68%. Profit after tax for the quarter ended December increased to 6.4 billion against 6 billion for the quarter ended September 30. ROA and ROE annualized for the quarter of December stood at 3.1% and 19.9% respectively. Earnings per share for the quarter was at rupees 8.04 and book value per share stands at rupees 164.6. Now getting to HDFC Life on an IGAAP basis, the profit after tax for the quarter ended December was at rupees 3.7 billion, grew 16% year on year. India embedded value at rupees 451 billion, improved 20% compared to prior year. On AMC, quarterly average AUM at rupees 5.5 trillion grew 24% year on year. Profit after tax for the quarter amounted to rupees 4.9 billion, registering year on year growth of 33%. Earnings per share for the quarter was at rupees 22.9. HDFC Ergo on an IGAAP basis, profit after tax for the quarter ended December was at 1.3 billion, registering growth of 6% year on year. Solvency ratio at 187% as of December end. HSL, our securities company, the total reported revenue for the quarter, total reported net profits for the quarter after tax was 2.3 billion as against 2 billion in Q2 23. Earnings per share in the quarter was rupees 144 and book value per share stands at rupees 1,253. On ESG, keeping up with our CSR commitment, the bank has undertaken multiple projects across India with the aim to address critical developmental issues such as sustainable livelihood, education, soil and water conservation, and key ratings and awards are on page 27 for reference. In summary, our results reflect robustness and growth across various parameters, driven by employees passionately working with our customers to execute the business model. This has resulted in advances growth sequentially of 4.9% and 2.9% sequential momentum in retail deposit growth. Profit after tax for the quarter increased by 33% versus prior year, delivering return on asset in the quarter of about 2% and return on equity of about 15.8%. Earnings per share reported in the quarter is at rupees 21.6 on a standalone bank level and rupees 22.7 at the consolidated bank level. Book value per share on a standalone basis is at rupees 556 and on a consolidated basis it is at rupees 576. With that, may I request the operator to open up the line for questions, please?
Thank you very much. We will now begin the question and answer session. The first question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, hi, good evening. Sir, I have two questions. Good evening, sir. So I have two questions. Basically, the first one in general is on deposit growth. So in general, there's a lot of noise around RBI having a discussion with banks on LDR. Plus, deposit growth has been very, very tight in November and December, irrespective of whether you've had a discussion with RBI or not. So how do you view deposit growth and LDR from here on? If you could give us some sense, target or guidance on how LDR will pan out or what LDR are you looking at in FY25? And a related question to that is that if deposit taking remains tight, irrespective of the LDR debate, then what would you choose? Would you choose to offer higher rates compared to competition because your ask rate for deposits is on the higher side now? Or would you choose lower margins? Okay, if the deposit situation remains like this for say 2 quarters?
Okay, yeah. Thank you, Mahrukh, for asking. If I miss anything, come back. But let me start with your first one in terms of the deposits and the CD ratio itself, right? Probably it addresses the broader points that many of them will have. If you think about, first of all, any conversations with the RBI is confidential and it is between the regulator and the bank. So we will not be able to talk about any individual conversations or anything. Right? So we'll keep that to the side. But that's not your main point. Your main point is in terms of the rate of growth of deposit as well as on the CD ratio, given where it is. So let's talk about that. Now on the deposits, if you see, on the first thing on the deposits, I do want to mention that how we approached it here. At an overall level, our deposits grew by 411 billion. At the overall level, our deposits was at that level that we grew. I'm closer to the mic. I think somebody is saying they can't hear. So 411 billion, that's the total growth that we had. Within that, if you see the retail deposit growth, 530 billion and 2.9% during the quarter. However, the non-retail deposit reduced by 118 billion, rupees 118 billion quarter on quarter it reduced. Almost 3.3% reduction sequentially in the non-retail deposit. Again, very price sensitive. We chose not to participate and get that price thing up, and we wanted to focus more and more on granular there. So that's one. And if you think about the individual component of various deposits, I talked about the current account growing at 3.2, and within the current account, the retail current account constitutes 72% and has been growing 3.8% sequentially. And the savings account deposits, I will come back and talk about the savings as such. Right? There is something on the savings which we need to see that, right? Where you are seeing two things on savings. One, given the rate where we are in peak, there is a preference for time deposit. Two, in terms of the spend, we are seeing good amount of spend that is happening from the customers. In our own base, we can see 18-20% spend from on the issuing side, on the acquiring side from a cards point of view. So people are spending. And one other measure we look at it is our aggregate of our card customers, what is the balances they have. Right? If you look at the card ANR versus the deposits against it, almost 5.4 times they have. Right? That means for every 100 that I have as my card balance outstanding, I have 5.4 times that in my saving in my deposit account in the bank. So there seems to be more spending room there to go. So that's one. And from a rate cycle point of view, and how do you overcome that is to get more customers. I talked about 2.2 million customers, 7.4. These are the kind of what we have. Now coming to the what does it all do from a deposit growth?
Hello, sir.
Yeah, I'm here. So I'm getting. You can't hear? Can you hear?
Maru, can you hear us?
Okay, I'll go ahead. Probably. You can hear Neeraj?
Yes, sir, I can hear you fine. Yes, Maru, now you're audible.
So getting to our CD ratio as such, right? Yes, the LDR, which is the CD ratio that you alluded to, is little more than 110% as we close the quarter. Over a period of time, if you see in this quarter, how did we manage the balance sheet? We had 1.15 trillion growth in loans, if you see, and we funded that through 411 billion on deposits, and you had investments going down by about 485 billion, and cash and cash equivalent by about 96 billion. So essentially, we funded that by the balance sheet somewhat coming, not on the asset side. We got that self-funded through some lower investments. That is what you're seeing in the LCR ratio going down to 110. So some of the securities came down and cash came down as the ICRR ran down on October 5th.
I think I'm unable to hear you.
Nirav, can you hear?
Yes, sir. Sir, line for Maruk has dropped. We'll move to the next participant. Next question is from the line of Pranav from Bernstein. Please go ahead.
Hey, good evening. Thanks for taking the question.
Good evening. Good evening.
Hey, I think question again related to deposits. So one question.
Yes.
When you think about deposits this quarter, instead of say the 400 billion that you treated, if you had to double or triple that number, which is the biggest constraint? Is it the LCR where you're hitting the constraint, or is it simply the cost of deposits, or is it the lack of good lending opportunities? Where are you seeing the biggest constraint?
Yeah, the biggest constraint is in the area of deposits, right? And if you look at what has happened in the system, very important to look at the the liquidity in the system, how it has moved. If you see, it has been positive ever since Q1 20. The system liquidity has been positive since Q1 20, and now it has moved to a negative territory all the way. If you look right now, this is the first quarter, full quarter, that Q3, that it is a negative 664 billion, right? That's the negative situation in the quarter. System has gone down by. That's the average that you're seeing. So it is the lack of liquidity in the system, rightfully so. If you look at how RBI has managed, there is no rate change that has happened, but the inflation that spiked 4 months ago, 5 months ago, has been managed through liquidity constraints, right? Through working on the liquidity side. That is what has happened on a temporary basis. But over a quarter to quarter, this is happening, but it is coming after more than 3 years, 3.5 years, right? You are seeing this liquidity on the negative. It has been there. If you look at the last 10 years, there have been several quarters in the past, in 13 or in 15, 2013, 2015, where it has been negative. But this order of magnitude negative is very recent. In the last 3 months, it has become negative. So that deposit is an important ingredient. That is the important constraint to grow, right? And we are at it. And within that, I will tell you, retail has done reasonable. We would have liked retail to do 50% more, 80% more than where we did. But it is the wholesale, if you see, not just lack of growth, it's a degrowth in the non-retail on the deposit side. That is where it is very price sensitive. We chose not to participate in that price as much as possible. We have avoided that so that we can consume some liquidity that we have and at the same time make progress on the asset side. But that can't continue for long, as you know. LDR ratio is at 110 something. So we do need deposits to be kicking in for the loans to be operating. That also answers what Mark was asking. Very similar thing that you're asking. Yes, we do need the deposits to be coming in.
Okay. Thanks, Srini. Thanks. That's all.
Thank you very much. Yeah.
Thank you. Next question is from the line of Suresh Ganapathy from Macquarie Research. Please go ahead.
Yeah. Srini, so just to understand what is going to drive your margins in future, because if I look at it, this quarter you have sold off 50,000 crores, your LCR is at 110%, so you can't go below that. So there is no excess liquidity assets at 110% LCR, right? And funding costs may remain elevated. So when you're saying I want to go from 3.4 to 3.7, incremental CASA mobilization is getting to be a challenge. Term deposit growth is high. Your HDFC Limited borrowings are sitting there at 7.5%. So deposit growth is finding difficult to meet your own loan growth requirements. When are you going to replace the HDFC Limited liabilities? So amidst all these challenges, what will drive your margins, say, from 3.4 to 3.7, say, over the course of next 18 to 24 months? Will it be yield on loans? Because it doesn't look like it can go through cost of funds. That's the first question. And if you can elaborate the movement in margins, some indication as to what will be the components and how are you going to manage the HDFC Limited liability replacement with deposits, point number one. And the second thing is, 1,500 branches doesn't look like it's happening this year because we have only opened 290 branches. 270 this year. So you're going to fall short of your 1,500 branches target by a wide margin. What is the thought process there? Over to you, Srini.
Okay, yeah, thank you. I'll take the second one first, topically. From a branches point of view, yes, there are little more than 500, 550 branches in the pipeline as we close the quarter, and we are targeting somewhere maybe 800 to 1,000 branches or so, right? If we do 1,000 branches, it would be good. There is more than 500, 550 branches are in the pipeline. So that's something on the branches. 1,500 is not something that will happen by March, right? 1,000 is something that is possible, but at this time we are having about 500 plus in the pipeline. That's 570 more precise in the pipeline. The second aspect of it is in terms of your levers for margin and the deposit as such at total level. if you look at the mix of products that we are having, one of the important lever is the retail mix to be enhanced, right? Retail mix has been continuously coming down, and that is something that will help us to go. And of late, in the recent times, if you see, we haven't had that kind of a market rate of growth on the unsecured as such. Our personal loan has been growing 2 to 3% over the last 2 quarters, you see. So we do have opportunity space there. That's part of our credit kind of a process where periodically they calibrate up and down. And now we believe that the overall credit, both from an NPA point of view and credit cost point of view, are at a benign state. And so whatever testing and other things may do, we are positioned to have a good growth there. That's one. Retail asset growth, particularly the non-mortgage retail asset where there is a yield, needs to come up. And the mortgage is another big opportunity that we have, both existing customers where we have almost 4.8 million pre-approved, pre-qualified database to go through, which we have done in our existing base who are eligible, that we are making offers and talking about it. And also 5.6 million customers who already have somewhere, we are targeting them. So that's in terms of the retail mix needs to go up. That is an enhancer for the margin. And to some extent picks up on the ROA too, right? So that is an important mix that goes. That's not what we have seen in recent times. In recent times, the wholesale growth has been overwhelming the retail loan growth. We do need to reverse that. That's part of the process in terms of what we are going through. Now getting to what are the other levers, which you also mentioned, but there are headwinds on that, right? CASA ratio. We are at 37.7. Even before merger, we were 42. Over a long period of time, we were 42, 43 thereabouts. We are confident of getting the CASA ratio back up. There are 2 aspects to the CASA ratio. One is the customer spending will abate at some point in time. And the second thing is that we are getting new customers. That is why it is important to get new customers. 2.2 million new customers, liability relationships were brought in this quarter, 7.4 million over the 9-month period. It is important to bring new customers and get them to a maturity. So that is an important thing that we are working on to get that from a CASA ratio to go back up. And also we are at the rate cycle. The rates haven't moved for several quarters now. And by all accounts, we are at the peak of the rate cycle. And the deposit repricing that needs to happen in a quarter or so should be done, because the rate cycle started in May 22. And then the CASA should be back to its normal growth, right? So that's something on the CASA ratio. We are waiting and vehemently pursuing that to come. The other aspect that you said, borrowings, whether the borrowings can, how do you replace the borrowings with deposits? Yes, 8% of our balance sheet was borrowings. Now it is 21% is borrowings. We do need to change that to deposit funding. But one other aspect that we have started to pursue even in this quarter is that the borrowings can continue as borrowings. So we got 7,500 crores of long-term affordable housing bonds that we have, infrastructure bonds that we issued in this quarter. The economics of that are like a deposit, not like a CASA deposit, but like a time deposit, right? Slightly better than a time deposit because you obviate the PSLC cost, and because the affordable housing is tagged against it. We do have almost 1 trillion Indian rupees of affordable housing in our asset stable that we can stack to. The DGI, the deposit insurance cost is obviated, and so there are some benefits that come. So it equates to slightly better than a time deposit at an overall level. But that doesn't mean we do need CASA, but there are other opportunities on the borrowings too.
Okay, and just one final question on cost. Srini, you guys have said you will bring down from 40 to 35% over the course of next 5 years. I know it's a long journey. The fact that we're opening lower number of branches, can we get to see some benefits, not quantifying, but some benefits in that reduction next year, FY25? At least there has to be a journey in that 500 basis point reduction, right? So we were at 40.4 last quarter, and we are at 40.2 or something like that. Around the same range. So do you think it can really come down in the next 1 year or so? Yeah. Sorry, thanks.
Yeah.
Last question. Yeah.
Yeah, we are with you, Suresh, on that. Yes, we do expect. Normally, while we don't give a forward-looking outlook, but on a cost to income, we always said that we want to take it down to the mid-30s, and that we will progressively take it down and not just towards the back end, but there should be an expectation that cost to income should be improving. And it is a function of certain efficiencies through better digital offering. That's one. Several things that are in the pipeline on technology rationalization is one that is a good tailwind that should count for it. And the second thing is that as we work on some of these margin, which is both the asset mix, the CASA mix, and the borrowings mix moving towards deposit, as we work towards that, the numerator is also an important contributor to get to that.
Okay. Thank you so much.
Thank you.
Thank you. Next question is from the line of Rahul Jain from Goldman Sachs. Please go ahead.
Yeah, thanks. Good evening, Srini. 2-3 questions. Number one, the whole debate between LDR and LCR. For you as a management team, what is it that you're focusing on? I know you put out, certain trajectory for LDR, but right now the LCR has kind of come off to 110. As the previous participant pointed out, 110%, clearly there's not really much room for it to go down. So what really is a key number to focus on for you all?
Okay. See, listen, both are important. It's like you need to walk and chew gum, right? You need to do both, which means LCR, we have said before that we'd like to operate between 110 to 120. We were at several quarters 113, 114, 115 thereabouts. Then for a quarter we went up, and then we have consumed as we see in this quarter we have consumed, right? So it is important around that level to keep that level of cushion to some extent, right? That's one on the LCR. LDR is important, right? We do want to ensure that the mix of funding moves more towards deposits. So LDR is important from that sense. And if you see currently 110, then if you look at where can this go, where can this LDR go? You know that if you look at our LDR prior to merger, it's very important, right? It's a recent discussion that is developing. Prior to merger, our LDR was at 85, right? Then now it's at 110. And if you remove the merger effect of the assets and the deposits on this, the LDR is more like a 89, right? And if you look at our historical range of what the bank has operated LDR over a long period of time, around that 85, 87, that kind of a range, that's where we operated historically. If you think about our LDR, that's where we operated. And today, if you strip out the merger effect, it's about 89. So essentially, the LDR is a function of what has happened on the merger. It's about 2 quarters run on the merger, we have run through 2 quarters, and we do have a kind of a path where we do want to replace borrowings with deposits and grow further loans with the deposits. That's the kind of a thought process. And so you should expect that the LDR to go down progressively over several quarters to come.
Yeah, the reason why I asked this question also, Srini, is because, we've bottomed out on LCR, as in it can't really go down any further. LDR is clearly elevated. So clearly loan growth outlook and the visibility thereon is looking a little difficult given the environment that we are in. So what do we prioritize, growth or margins? If we prioritize growth, then clearly the loan growth has to come off for us to start, bringing these ratios up, to a more acceptable range. Or if you have to grow, then margins clearly takes a knock because you'll have to offer or maybe increase the deposit rates further. So how are you planning to balance the two?
Okay, so I do want to one thing mentioned, right? We are not caught up and we are not into one level of rate of growth as such, right? If you look at our rate of growth, there are sometimes we are slower, sometimes we are faster. But all we have done is that over a period of time, we have always doubled in every 4 or 5 years. That's what we have done, right? Quarter or even a year can be different, but over a period of time, that is what we have done. So growth is not something that we are caught up with saying this is the rate of growth that we want. Over a period of time, we want to, because that's the investment we have done, we need to harvest returns of those. So we are focused on returns. So that takes you to the margin, right? Would you focus on margin or growth? We certainly do not want growth for the sake of growth. If you look at our wholesale growth, we had 1.9% in the quarter. Enough demand was there. There were several banks undercutting and taking, and we let that move on, right? We don't need to be participating. If it does not give returns, we don't want to be there. And so that's something that we are focused on. We want to do the products that are going to give us the returns. Now, on the margin, very important that you talked about the margin. Margin is important, but the first passing is about the returns. What does it give from an overall ROA point of view? That's the first pass. Then it comes, because when you do a product pricing or a product choice to a customer, we're looking at returns more than the margins as such. Margins, to the extent that the mix appropriately gets calibrated, the margins. For us, we have never had this margin conversation because our mix has been predominantly retail, and the retail rate of growth over a decade, if you see, has always outstripped wholesale. So there was not a necessity, there was no conversation about any margin, because it comes with a hefty margin, and it comes with a credit cost also. And our credit cost is at a very benign state of sub 50 basis points right now. And if you look at our credit cost, adjusted for the mortgages, you'll see that the mortgages, because of the denominator and the low loss rates, when credit cost, what is the mean on the credit cost? Call it 70-80 basis points. That's the mean, and pre-mortgage merger, 110 basis points. So what due to the mix change that has impacted the margin, that has come through in the credit cost line. So certainly we are focused on profitable growth. That is, I hope that answers you in some manner that you are trying to seek.
Sure. Just two small questions. The branches, you said this year maybe 1,000. So is this a new trajectory that we're looking at, or you'll go back to 1,500 or thereabouts in the following years?
See, again, I'll tell you one other constraint that we are also working through on the branches. This URC. This URC is something that is required, right? The mix between the unbanked rural center and so on. Selecting that availability. What is that URC that is available, so that we are able to get that mix appropriately, right? So there is a targeted percentage, with a regulatory target on URC. That is more internally we would do, but we need to have that mix between the URC and the non-URC, so that we can grow progressively across in a balanced manner within the regulatory approvals, right? That is what it is. So if you look at whether we go back to 1,500, I think Sashi has alluded to that over a period of time, we do want to get to the 13,000, 14,000 type of branches, not just for the sake of branches. It is the geographical presence that we can have, so we can tap into that pockets of both the deposits and lending opportunity in that area. So it's not just deposits and also the lending opportunity in the area. So we would be there, but there is no hard kind of, we're not going to push ahead with only one number, but currently this is what we are seeing.
Sure. You've been very generous, with your time. Just a small question on the infra bonds. So you raised some money in the last quarter, I think 7,500 crores. Do you have eligible assets even sitting on the balance sheet against which you can keep raising these infra bonds, and how much would that be?
We have eligible assets close to 1 trillion Indian rupees, as I mentioned. So that's part of which is it can have a qualification in the sense that you may have PSL benefits, because you will take it off the top line to the extent that you're able to tag the bond and the affordable housing, and you will get the other benefits that I mentioned, that the cost on the PSLC or the deposit insurance, those things are obviated. But still, any day we need CASA, but to the extent that there are time deposits, this economics is better than, even slightly better than the time deposits due to these. Yes, there are enough asset room. If that is your question, do you have enough assets on the asset side to face off against this infra bond? Yes.
Brilliant. Thank you so much, Srini. Sorry.
Thank you.
Thank you. Next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi, Sunny. So given that overall liquidity is tight, plus the deposit traction all said and done, this quarter has not been very encouraging. So when do we see in terms of tweaking the rates, given that now at least the repo rates have sustained? Would we ever look at raising deposit rates beyond 7.2 just to make sure that we are on our target to get the deposits and at least sustain the growth momentum even on the asset side? So will there be a thought? No doubt you have earlier said that we will look at branch expansion that's going pretty slow. Even in terms of like activation of the field force, still not that great response. So at what time do we look at tweaking the rates just to ensure the deposit traction is what we were envisaging earlier? Yeah.
Okay. See, deposit pricing is not a tool that we are having in our sales and relationship process, which means it is not a driver. The conversation would never go to say, I am the best priced deposits come here. It's not a conversation, because that's how, if you look at some of the comparative pricing on our deposits with our peers, we are more or less in that line, right? With our top peers, that's the kind of a pricing that we are positioned to. We're not trying to differentiate on the pricing, we're trying to differentiate on other offering features. That's one on that. Second, in terms of the market share, you touched upon the growth rate and the market share. I do want to allude to say that we do believe that on an incremental basis, 18-20% market share we do garner, right? That's part of whatever is the size that we have got, whatever is the level at which we are growing, we continue to maintain that superior rate of growth to the market, gaining market share on an incremental basis, getting that in the high teens to 20 type of incremental market share. Rates are not a play. We are not, and that is part of the reason why our non-retail deposits degrew by 3.3% in this quarter.
Yeah. Okay. And secondly, with respect to tax write back, so last time when there was a write back, you indicated that maybe it might not repeat and we should see it normalizing towards 25 odd %. But that benefit is still continuing. So if you can highlight in terms of, is it expected to continue? What is actually leading to this kind of or maybe a lower tax rate, I would say, or maybe this is like the investment gains which have been there. It's on that count. If you can just highlight that, yeah.
The tax benefits that we booked in are consequent to two things. One, there were certain favorable orders received relating to HDFC Limited past assessments. So that's one. And two, there were some favorable orders received relating to the bank for the past years. And so that is based on those assessments, we have determined that certain provisions are no longer required. Depends on time to time, and there is no such kind of a routine timing that I can predict when these orders come and when they get done. But yes, these are episodic from that sense. We receive favorable orders, we assess and we take it. And in this quarter, we have had two of them like that, yeah.
Okay, so all orders which have been received, which have been favorable, they are more or less accounted for now. And
more or less, yes.
Which is pending.
That is correct, yeah.
Okay, and lastly, if you can highlight in terms of the maturity of the borrowing, HDFC Limited borrowing over next 1 year, which is falling due. Okay, and any quarter we would see any kind of a volatility in that maturity.
Maturity profile is 20,000-25,000. There is no big maturity, at least over the next 2 to 4 quarters. It is evenly there. There's not a spike of $1 trillion going away in a quarter or $500 billion going away in a quarter, that kind of profile. And I think annually we do publish the profile of those, and they should soon get to see that, yeah.
Oh, okay. Okay, good. Yeah, thank you.
Thank you. Next question is from the line of Chintan Joshi from Bernstein. Please go ahead.
Hi, thank you. Can you hear me?
Yes, Chintan. Hi, go ahead, please.
Yeah. Hi, Srini. So can I go back to the LD ratio discussion?
Yes.
What I'm hearing from you is that, it does need to come down. but also, growth will remain intact. So I'm trying to square this circle. How, the only way borrowing LD ratio improves is if you grow deposits faster than lending. Is that what we should expect, by FY25? And the pace of that, if you can talk about, do you have some target in mind, or do you look at market conditions and do your best? How should we think about this?
No, good. Thank you. One thing I do want to mention is that the growth rate, sustainability of the growth rate is not irrespective of what the CD ratio is. CD ratio has to improve, right? As I mentioned, typically we have been in that mid 80s to high 80s. The merger took it to where it is today, past the 100, and over a period of time we do need to bring it down. So we can't keep the CD ratio to be growing all the time. That's not a proposition that we are envisaging. So that takes the second part of what you asked in terms of the deposit growth and how you should think about the rate of growth. Yes, we do envisage that the deposit rate of growth should outpace the loan rate of growth. And for this CD ratio to progressively come in and for the economics to work, the deposit rate of growth should be at least 300-400 basis points higher than the loan growth. Only then the economics will work better. So yes, that is the kind of a thought process that we have. Yeah.
So the other question I have is on borrowings and debt securities. If I look at HDFC Limited balance sheet as of FY23, there was about 1.7 trillion that was going to mature over the next year as of FY23. However, we have not seen that mature. If anything, borrowings have gone higher today than the pro forma combined FY23 balance sheets. Is this, what was the thinking behind this? Because, one way of looking at this is there was an opportunity to reduce borrowing, but it was not taken because there was profitable lending growth out there. Is that the way you thought about it, or if you can explain that thinking would be helpful?
Okay. See, in this time period now, 2 quarters have gone by after the merger, and the borrowings have remained or actually gone up in this quarter by almost 209 billion Indian rupees. It has gone up. Out of which about 7,500 is infra bonds, which economics work well. We have taken that. The rest are either market borrowings or other treasury related actions, right? So it is only one item, which is the infra bond, which is the borrowing as such that has gone up. The rest are market related activities which are there, right, in that borrowing. The other aspect of it is that should you expect this to go down as the maturity? I think another person was asking about the maturity itself over the next several quarters. Yes, there are maturities coming, and we envisage to the extent that economics work, we will have a similar replacement. If not, it has to be replaced by deposits, and that is part of how the rate of growth of deposits need to outpace the loan growth. Otherwise, we will not be able to keep up with the loan rate of growth.
Understood. And finally, on the CRB business, which is it's growing really fast, what is the overall lending yield of the CRB loan book, so that we can understand, what is the mix impact on the overall lending yield from the CRB, given that it's growing so fast?
Okay. See, the CRB yield comes in about between 9 to 11% depending on product. There are certain products that go above that. There are certain products which are around that 8.5, 9, but on average it is slightly above 9% type of yield at an aggregate level. But there are several products, as you know, within the CRB segment, from business banking to emerging corporates to agriculture loans to SLI loans, to the commercial vehicle and so on and so forth. So they got different price points, but on an aggregate average, if you look at it, it's north of 9%.
So it is in line with the overall group lending yields. It's not above the average of the balance sheet. It is in line with it.
It's a good assumption. Yes, it is not above the average. It is at that level. It is not dragging the overall average down as such in any meaningful manner. Yeah.
Understood. Thank you.
Thank you. Next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi, good evening, and thanks for the opportunity. Sunil, two, three quick questions. One is on the Bandhan Bank stake sale that has happened in this quarter. So if you can quantify the gains on this sale, how much it has flown in this quarter from that?
Yeah. See, I talked about that 15 billion with the P&L on the 15 billion or so on the overall I mentioned. So not necessarily, I won't talk about any individual particular item, right? But from an overall point of view, I did talk about the mark-to-market and the trading treasury investment portfolio income, 14.7, 15, right, which is there.
Right. So this is included in the total, but you are not like.
It is included. It is included. It is included. Yeah.
Okay. And secondly, on the Credila, have you booked the gains in this quarter, or it will come in 4Q? Like how are we looking at that?
Okay. No, Credila, nothing has been booked in the December quarter. We are waiting for regulatory clearance before the transactions can close. So we are working through, or the potential purchaser is working through certain things to provide, and we are hopeful to close soon, but there is no particular concrete time that I can give, right? They have to go through approval process before it can conclude.
Okay. And lastly, on the contingent provisions, this quarter we have made 1,200 odd crores of contingent. So any particular level we want to reach, or is it just like the flowback of the excess gain that we are having right now that we are using that? So any thoughts around how do we look at this contingent provision number?
Okay. See, the contingent provision that we built in the quarter, rupees 12.2 billion, we attributed on a prudent basis towards the AIF, right? There is a RBI regulation to account for and look at AIF in a specific manner. So we took that chance to say on a prudent basis we need to provide, and so we did build a contingent provision against this. As I mentioned, the fair value of the AIF is almost 5 billion more than the carrying book value, but we made 100% provision on a prudent basis. So again, we evaluate this quarter to quarter, but that's the process. That's a regimented process to look at it quarter to quarter. There is no such targeted level of build or release that we have. We will assess it every quarter and certainly at every year end.
Right. Okay. Thanks so much, Sunil. Thanks a lot.
Thank you. Next question is from the line of Abhishek Murarka from HSBC. Please go ahead.
Yeah, hi, good evening, Sunil. Thanks for the opportunity.
Good evening, Abhishek.
Sorry. So one question is on the unsecured loans. So after this RBI circular on risk-weighted assets, and also just the nudge that has been happening on NBFCs as well, what is your approach? So part one, what is your approach to unsecured loans, especially personal loans? Will that slow down? If yes, when you were talking earlier about bringing up the yield on non-mortgage retail assets, how does that affect that strategy? And second, on NBFCs, again, what's the approach? Will you limit the percentage mix, or will you sort of limit the absolute exposure? How do you plan to move ahead?
Okay, yeah. Let's look at the retail unsecured that you alluded to. See, the retail unsecured is extremely profitable product, and we like it. And it has to go through our credit filter, and we've been in that for a long time, and one of the best scorecards we believe we have that. If you look at the delinquency profile on that, is fantastic. The delinquency profile, the NPA profile is better than a secured book that we have, so we like it. There are times it gets calibrated up and down, and we are confident of growing that book. And let me tell you one important thing on that unsecured as such. Pre-merger, on the retail book, our unsecured component was 41%. Post-merger, it is about 22%. So if anything, we created more kind of a runway for a faster growth. But when we say faster growth, we are not talking about something that is a 25-30% thereabouts kind of rate of growth. For us, faster growth is to go into high teens to 20 type of rate of growth. That's what we have had in the past. That's why I'm more than telling you what we will do, I'm trying to tell you what we have done. And we think that that is what we will do rather than do something new about it. So we have enough headroom, enough runway and opportunity on that. It's extremely profitable product. So that's something to keep in mind on the unsecured. NBFC, our approach to NBFC has always been one, for PSL lending, we do want that. For corporate houses, right, part of various NBFCs affiliated to corporate houses, something that we work with, because that's a much broader relationship across that corporate group that we have. So that's it's quite profitable, and we like it, and we work through that. One thing that I do want to mention is that yes, the risk weights do add in terms of the capital that is required for it. Irrespective of that, we look at the profitability. They are quite highly profitable at the enhanced risk weights, both ROA or ROE that you see, and we like to go with that.
So there will be no sort of approach to limit the, let's say, percentage of overall exposure to NBFCs, in light of whatever, nudges have come from the regulator, or caution, let's say, that would have come.
Correct. The way to think about it is that where it is to be directed lending, which is priority sector, is number one preference. Right? And by the way, some of our NBFCs are government sponsored NBFCs. Right? So, and they are not into consumer lending at all. So I do want to distinguish. Of course, the circular does not distinguish between different categories of NBFCs. So our NBFC does not necessarily need to be lending only to consumers or of segmentation which is lower than the bank targeted segmentation for lending. No. NBFCs are also government-sponsored, government-linked NBFCs are there, where we have a good relationship with them.
Okay. And just another one on the cross-sell, at the time of the merger, we were talking about how, you benefit from cross-selling, your products to the customers who are coming into the fold. How do we track that, and when do we start seeing those cross-sell benefits? Either in terms of higher retail fee, or can you start disclosing some sort of cross-sell metrics? So how do we track whether that's really accruing or it's taking time?
Very good. Thanks, you touched upon that. I'll give you one, and I'll tell you 2-3 things that we will start to publish and show to you. One is that we said we want savings accounts. Right? That's one, because we want to offer the bank not just a mortgage product. So if you look at 1 month, the last month, December, right? We in October we showed to the broader world in terms of how various digital approach that we have taken to offering this bundling of products. Savings account is an important part of that product suite that we offer. Among the dispersals that we had in 1 month, if you take 40,000 plus dispersals, first dispersals, because I'm not counting for the dispersals which are ongoing, right? Second installment, third installment, leave that to the side. On the first dispersals that have happened in the month, in December, roughly half is existing to bank and new to bank. Half is that. Among that half, which is the new to bank, almost 65% of them we have penetrated with the savings deposit. So we've gone with the 65% penetration to start with, right? I'm talking about the December where we are. And that penetration comes with the deposit balance, at least 1 to 2 months of EMI, which is 30,000 rupees to 35,000 rupees on an average we have taken from that customer base where we have opened. So we will publish these. So one is savings account as a product, and what is the penetration on that? That's number one. And I give you an example of 65% of new to bank first dispersals, we have had that, and we want to take it to 90, 95, 99. We'll keep tracking and reporting that. The second one is the credit cards. We're just beginning on that one. We'll report on that as a product in terms of how we are offering credit cards. The third is consumer durable. Consumer durable, again, one is the offer, the second one is the drawdown, because the customer will not, we will make that offer on the consumer durable, the customer will draw down a month or a quarter or 6 months later as the house is ready for the person to move in and do. So, and then over a period of time, we will bring in the other products. So insurance also is something that we will start to disclose to see the penetration level of insurance. The things like the demat account and the mutual funds and those sort of things, over a period of time we will come with that. But there are 9 products that we will come up with, out of which 3 are digitally enabled. The rest will be soon, and we will start to report them and show to you.
Sure. Thanks. It will really help to get some more granularity, because that will help us, figure how the cross-sell effort is going. So thanks. Thanks for your time.
Thank you. We'll put up a page or 2 from next time, and we'll have that.
Sure. Thank you.
Thank you. Next question is from the line of Anand Bhavnani from White Oak Capital. Please go ahead.
Thank you for the opportunity. I have a question on the consumer behavior, and this is more to do with, seeing revolve rates on credit card being, much lower than pre-COVID levels. Similarly, on the on the savings account side, the growth rate is weak. So, can one surmise that because of, good apps available on mobile devices, consumers are now being very, active and not giving into the inertia on both the asset side, the credit card? They are not revolving, they are just taking personal loan or something. And similarly, on the liability side, the smart consumers are moving away their deposits to an account where they are getting 7-8%, whereas we are giving, let's say, 3.5%. So, have you done any behavioral analysis on both asset as well as liability side to see how across the broad spectrum of your customers, is there any data to prove these theses?
See, in terms of the customers, you touched upon the revolver. Thank you for touching that. See, the revolvers haven't grown. If anything, actually in this quarter we did see slight reduction in revolver percentage, right? We're not seeing that. And in some other question I did allude to how card bunch of customers who have credit cards and savings accounts with us, when you see their balances are 5 times, little more than 5 times, 5.4 times their balances is what they have in the deposit accounts. So that is also healthy. It was less than 4 3 years ago. Now it is 5.4. So it has grown. That's the second thing. The third thing, in terms of whether some of the digital properties are enabling less use of card revolving and alternatives. See, in our customer segment, that's not something that we are seeing, because it is more of the segment that we have chosen and working on is little more higher rated. That means little more higher score customers. I think we have talked about the revolvers 1 to 3 months and 4 to 6 months and 6+ months. Call it 6+ months revolvers. Across these 3 revolving categories, we have not seen pickup happening. So that's part of the customer base, and that's part of the cash that they have, or some of them have got impacted through the COVID and come out of it and not survived and come through it and not indulging in any of these things. And some of them who do take it for a short period of time, right? So that's the 1 to 3 months category. If you see, they take for some short personal loan, or they don't want a 2-year or a 3-year or whatever the tenor personal loan. They want it for a short period of time. They don't mind taking it. So we do think that the category is very attractive and very nascent, because you know that there are only kind of 90-100 million credit cards in this country, and you would expect that to be north of 500 million. So we have enormous room to go. The other aspect is that whether alternative payments, UPI or anything, those kind of things, or direct debit to system, whether those things are, that would only increase the balances in the savings account. So somebody who's using UPI previously was drawing down cash and paying through, so the cash was going out of the bank. Now the cash is in the bank account, and is using UPI, so that it only enhances, anybody using UPI only enhances balances in the account. So there are pluses and minuses across all of these, but at the end of the day, the customer segmentation that we are working with, we're confident that would bring in the balances and grow as the economy grows.
Sure. But the question is whether the minuses are, overwhelming the pluses. Because the account opening these days is less like an hour's affair. And if a bank is offering 7-8%, and we are seeing these banks which are offering 7-8% are seeing very high growth rates on the liability side. So is it that the smart customers of yours are now using these properties and it's a structural change and hence it will be a headwind to our deposit acquisition targets? Okay,
there are two things I want to respond to. One is if you look at us from a market share point of view, we have been gaining market share. Our market share is at about 10.5%, and it continues to grow. On an incremental basis, I think I alluded to, our assessment is 18 to 20%. So we are keeping up with that. Yes, there may be some customers who go, but from our rate offering point of view, we offer, you're talking about the savings account rate, but on a savings account rate is what we offer 3.5. On the time deposit, we are more or less in line with the competition, significant peers. If you see, we are more or less in line with that on a time deposit rate point of view. From a savings account, yes, we do continue to. That doesn't mean somebody else cannot grow. We are growing. And think about it, still the public sector banks, from where all of the private sector banks, including the ones that you alluded to, offering 7% or 8% on savings account, those are all in the private sector segment. And the market share there is coming from some public sector, because all the private sector banks are gaining market share.
Sure. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, we will take that as the last question. I would now like to hand the conference over to Mr. Vaidyanathan for closing comments. Over to you, sir.
Okay. Thank you, Nirav. Thank you all for participating. We appreciate you dialing in at this hour. If any more questions, comments, or clarifications required, please feel free to reach out to us. Our investor relations team would be happy to connect directly with you or with me, and we can have a conversation. Thank you. Bye-bye.
Thank you very much. On behalf of HDFC Bank Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.